Have you ever wondered how bailouts impact the economy and your investments? Well, let's unravel this financial puzzle together. A bailout is essentially a financial lifeline thrown to institutions or companies teetering on the brink of failure. The government steps in, providing funds or taking on liabilities to pull them back from the edge. Remember the global financial crisis of 2008? The U.S. government bailed out major banks, insurance companies, and auto manufacturers. These bailouts prevented a complete economic meltdown, but they also stirred controversy. Critics argue that bailouts create moral hazard, encouraging reckless behavior in the future. Supporters, on the other hand, emphasize their role in stabilizing the economy during times of crisis. Whether you agree or disagree with the concept of bailouts, they undeniably have significant effects on the economy. They can shake up markets, influence interest rates, and shift economic trends. But can bailouts present investment opportunities? Let's dive into it. Imagine buying stocks at a discounted price and watching them skyrocket once the economy stabilizes. This is the enticing prospect of investing in bailed-out companies. When a company is on the brink of failure, the government may step in with a bailout to prevent a total collapse. This is typically a last resort action to save jobs, stabilize the economy, and protect the interests of investors. A bailout can come in various forms such as loans, grants, bonds, or a combination of these. Often, when a company receives a bailout, its stock prices initially fall. This is due to a variety of factors, including market uncertainty and a lack of investor confidence in the company's ability to turn things around. But for the astute investor, this can present a unique buying opportunity. Here's the strategy. Buy stocks in these bailed-out companies while they're undervalued and then patiently wait for them to recover. As the company stabilizes and begins to show signs of growth, its stock price can increase, potentially leading to substantial returns on your investment. This strategy, however, is not without its risks. There's always the chance that a bailed-out company may not recover, leading to further declines in stock prices. It's also possible that the terms of the bailout may dilute the value of existing shares. Before investing in a bailed-out company, it's crucial to thoroughly research the company's financial health, understand the terms of the bailout, and consider the potential impact on the company's future. Furthermore, it's important to remember that investing in bailed-out companies should be part of a diversified investment portfolio. This means spreading your investments across a variety of asset classes to minimize risk and maximize potential returns. In essence, investing in bailed-out companies can be a high-risk, high-reward strategy. It requires a keen eye for identifying undervalued stocks, a strong understanding of the company's financial situation, and above all, patience. This strategy requires patience and a keen eye for undervalued stocks. Treasury bonds are considered one of the safest investments, but they can also benefit from bailouts. Let's dive into the world of treasury bonds. When the government steps in to bail out a struggling sector, they often finance it through the issuance of treasury bonds. This is essentially the government borrowing money to fund their initiatives with the promise of paying back the original amount plus interest over a fixed period of time. Now, how does this connect to you as an investor? Well, when these bonds are issued, there's an increased demand in the market for them. This is because they're backed by the full faith and credit of the government, making them a very safe investment. So, when bailouts occur and more bonds are issued, it can be a great opportunity for investors to buy these bonds and secure a steady flow of income. Investing in treasury bonds comes with several benefits. First, they offer a guaranteed return, as the government is obligated to pay back the bond's face value plus interest. Second, they are a great way to diversify your portfolio since they often move in the opposite direction of stocks. This means when the stock market is down, your bonds can help stabilize your portfolio. And third, they're highly liquid, so you can easily buy or sell them whenever you want. However, it's important to understand the risks involved too. While treasury bonds are relatively safe, the returns may not be as high as other types of investments. For example, stocks may offer higher potential returns, but they also come with higher risk. Furthermore, if interest rates rise, the value of your bonds could decrease. But Despite these risks, treasury bonds remain a staple in many investment portfolios. They offer a way to earn a steady income while also providing stability and diversification. So, when the government steps in with a bailout and more bonds flood the market, it could be an opportune time to consider adding them to your investment strategy. Remember, bonds offer stability, but the returns may not be as high as other investments. Gold has been a safe haven for investors during uncertain times, and bailouts are no exception. When financial markets are turbulent and governments step in to bail out struggling industries or economies, it often leads to an increase in government debt. This debt, in turn, can trigger inflation. Inflation is a scenario where the cost of goods and services increases over time and the purchasing power of money decreases. Here is where gold and other precious metals come into play. Precious metals like gold, silver, platinum, and palladium have intrinsic value. They are not subject to the whims of government policies or the volatile nature of the stock market. When inflation rears its head, the value of these metals often goes up. This is because as the value of paper currency decreases, the relative worth of these tangible assets increases. Investing in precious metals can provide a level of security. They can act as a hedge or protective barrier against inflation and economic uncertainty. When other investments are performing poorly, precious metals often shine. But as with all investments, there are risks. The price of precious metals can be volatile. While they can provide a safe haven in times of economic uncertainty, they can also experience sharp price drops. The market for precious metals is also less liquid than other investment markets like stocks or bonds. This means it can be harder to buy or sell precious metals quickly without affecting their price. Investors can access precious metals through various channels. They can buy physical gold or silver bars or coins. They can invest in exchange-traded funds that track the price of these metals. Or they can buy shares in mining companies that extract these metals from the earth. Each of these options comes with its own advantages and disadvantages, and investors should carefully consider their own financial goals and risk tolerance before diving in. Precious metals can provide a hedge against inflation and economic uncertainty. So, as we navigate through the uncertainties of bailouts and their aftermath, it's worth considering adding some sparkle to your investment strategy with gold and other precious metals. Short selling can be risky, but it can also be profitable during a bailout. So, what's short selling? Picture this. You borrow a book from a friend, sell it to someone else, then when the price of the book drops, you buy it back and return it to your friend. You've just made a profit from the price difference. That's short selling in a nutshell, but instead of books, we're dealing with stocks. In the context of a government bailout, short selling can be a strategy to capitalize on falling stock prices. When a company receives a bailout, it's often a sign of financial distress, which can lead to a decrease in its stock price. Investors who anticipate this drop can borrow shares of the company's stock, sell them at the current price, then buy them back after the price has fallen. The difference between the selling price and the repurchase price is their profit. But don't be fooled by the simplicity of the concept. Short selling is not for the faint-hearted. It's a high-risk strategy that requires a deep understanding of the market and impeccable timing. The potential for loss is theoretically unlimited, because a stock's price can rise indefinitely. Remember, you're borrowing shares, not owning them, and you'll have to return them eventually. If the stock's price skyrockets, you'll have to buy it back at that higher price, leading to significant losses. However, the potential rewards can also be substantial. If you've done your research and the stock price plummets as expected, the profits can be significant. It's a strategy that can work well during a bailout, as the economic uncertainty can often lead to falling stock prices. To sum it up, short selling is a strategy that requires a keen eye for market trends, nerves of steel, and a high risk tolerance. It's not for everyone, but for those who can master it, short selling can be a powerful tool in their investment arsenal. Short selling requires skill and timing, but it can be a profitable strategy during a bailout. Diversification is a key strategy for any investor, especially during a bailout. This is not just a catchphrase, but a fundamental principle of smart investing. Why, you ask? Well, it's akin to not putting all your eggs in one basket. By spreading your investments across a variety of assets, you can mitigate the risk of a single investment's performance drastically affecting your entire portfolio. This is particularly important during a bailout, when market volatility can cause significant fluctuations in asset prices. Think of it this way. A well-diversified portfolio is like a sturdy ship in a stormy sea. While individual investments may rise and fall, the overall portfolio remains relatively stable, weathering the storm. The benefits of diversification include not only reducing risk but also potentially increasing returns. By investing in a mix of assets with different risk profiles and growth potentials, you can balance risk against reward and enhance your overall return potential. Diversification can help protect your portfolio during uncertain times. So we've discussed 5 investment strategies during a bailout. Let's quickly recap. First, there's the option of buying into bailed out companies. These corporations often present a unique opportunity for investors to buy low and sell high as they recover. Second, there's investing in treasury bonds. When the government steps in to bail out companies, it often does so through the issuance of bonds. These can be a reliable and safe investment option. Third, we've talked about investing in gold and precious metals. These commodities often increase in value during economic crises, acting as a safe haven for investors. Fourth, there's the strategy of short selling. This can be a bit riskier, but the potential for high returns is there. And finally, we've discussed diversification. Spreading your investments across different assets can help reduce risk and increase potential returns. Remember, investing during a bailout requires careful planning and risk management. Happy investing!